I think for gold to really break out, you have got to see the equity market break down in the US. You've got to see the Fed then truly step back and start to cut rates and the dollar to go. That, I think, would set you up for this solid breakout that we want. And, maybe at that point, our initial target on gold would be around 2,400. But if you really want to see gold take off, you've got to see a Fed that not only pauses, but starts to cut rates.
In a recent assessment, Julian Brigden, co-founder of Macro Intelligence 2 Partners, has expressed a bullish stance on gold, particularly in a tight monetary environment. According to Brigden, 3 key factors must align for gold to experience a significant surge. Firstly, there needs to be a breakdown in the U.S. equity market. Despite potential concerns surrounding the U.S. jobs report, traders have remained unfazed, continuing the trend that has propelled the Nasdaq 100 up by over 45% this year. Brigden emphasizes that, besides a resilient equity market, the Federal Reserve's intervention through rate cuts is crucial for gold's substantial breakout. A noteworthy economic forecast adds weight to Brigden's assertions. An ING economics note suggests that an economy displaying clear signs of deceleration could prompt the Federal Reserve to cut interest rates at least 6 times in 2024. Economist Knightley anticipates initiating rate cuts in the second quarter of the following year, with a total reduction of 150 basis points. Brigden envisions this economic scenario as the catalyst for a substantial breakout in gold prices, with an initial target of around $2,400. Traditionally viewed as a safe haven during economic or political turmoil, gold tends to attract investors seeking shelter from uncertainty and potential catastrophes. The anticipation of rising inflation, eroding the dollar's value, further underscores gold's appeal as its price in dollars is expected to increase. However, Brigden underscores the practical considerations of owning gold in such scenarios. The storage and accessibility of gold become critical, with Brigden cautioning that merely having it in a trust may not be sufficient in dire circumstances. Before diving into Julian Brigden's insightful interview, subscribe to our channel and give this video a big thumbs up.
I'm structurally very positively orientated toward precious metals. I've got quite large, percentage holdings in my own portfolio. I think, though, one's got to be realistic. As I said earlier, I think if we're in an environment where policy needs to remain tight for now, I think, excuse me, I think that doesn't leave much opportunity for any assets, right? If policy works via financial conditions are essentially a basket of asset prices, and if financial conditions have to remain tight, asset prices in broad terms can't go anywhere. Now, maybe gold could go up, but then bond yields have to go down, or stocks can go up, and bond yields have to go up, right? We have to keep that thing stable. So I look at precious metals, I like them as a holding. Do I think that anything is really going to perform over the next year or so? I'm not sure, right? I think some dynamics would have to change dramatically. I think for gold to really break out, you have got to see the equity market break down in the US. You've got to see the Fed then truly step back and start to cut rates and the dollar to go. That, I think, would set you up for this solid breakout that we want. Maybe at that point, our initial target on gold would be around 2,400. But, some of these more outlandish 5,000, 6,000, you and I off camera were talking about, I'm not sure we want to be in that world. I mean, Grant Williams and I were, I don't know, you probably might be interviewing him, we were chatting last night about this, and we both have got this somewhat maudlin sort of long-term view of the world. But it isn't such a great one. I mean, I think you've got to start at that point to considering things like, okay, so I've got my gold, how do I have my gold? Right? Is it in some trust? Well, that's frigging useless, right? If the muck hits the fan, where do you have it, right? How are you going to protect it? Where are you going to be living? It's great. Maybe you have got a whole bunch of gold, but you live in Manhattan or you live in central London and there's riots going on everywhere. I did have one client of mine who said, I've got all these kilo bars that are in Zurich. I remember this conversation and I said, oh, so end of the world, you're just going to jump in the super lightweight Ferrari from Sevenoaks and you're going to drive through France, which won't be rioting, turn up at the borders of Switzerland and said, oh, it's Mr. X coming to pick up my kilo bars, and they're just going to let you in, right? I mean, it won't work like that. So I think we've got to be, if we do get to that point, and I'm not talking, this is way beyond a sort of 1970s period of extended high inflation and a nasty world, but I'm true like societal breakdown, which I think some people at this conference may slowly, quietly lust for. There's lots of other dynamics that come into play at that point.
The ongoing surge in gold prices is intricately tied to the delicate dance between the precious metal and the Federal Reserve's policy decisions. Despite the central bank maintaining its tightening stance, gold is experiencing renewed buying momentum, with markets factoring in the possibility of a rate cut as early as March. Federal Reserve Chair Jerome Powell's recent statement, expressing uncertainty about the adequacy of current monetary policy to curb inflation to the 2% target, has done little to sway market sentiments. Interestingly, the CME FedWatch tool reveals that markets are now assigning a probability of over 50% for a rate cut in the first quarter of 2024. Julian Brigden challenges the prevailing expectation that a slight adjustment in interest rates will swiftly usher a return to risk-on sentiment. He underscores the need for a deliberate and extended approach to address prevailing economic imbalances, suggesting a more protracted journey before the market experiences a significant shift. The Federal Reserve's robust monetary policy poses a risk for gold, but analysts suggest a slowing economy might prompt the central bank to shift toward rate cuts sooner than expected. Let's get back to the interview.
So I think, look, we have to sort of pass some of this down. If we look at the Treasury market, we've been structurally bearish on Treasuries really from sort of 2016. We think just the long term, and I'm talking very long term, structural trend now is for global yields to rise. We had a break during COVID, obviously, because that sent yields crashing, but the structural trend, whether you look at sort of demographics, pool of available savings, demands from countries to issue debt, right? Because we are arguably fighting three wars if you look at the United States. We have a Cold War with China, we have a hot war with Russia, we now have a hot war in the Middle East, and we have a climate change war, right? Vast quantities of government spending. Somehow it has to get funded. Pressure is for yields to rise. So we think we've kind of hit this, well, we're getting close to sort of a turning point in fixed income. We'd had a longer term target of 5%. We got there on 10-year Treasury yields. So kind of where we go from here, I think depends a lot on some of these other risk assets. The dollar is one of them. I think a lot of people, particularly in the precious metal space, really want to see the dollar crash, right? And structurally, I'm a big dollar bear. I just think it's the question of when you hit that tipping point, and timing is really very, very important. If you look at, say, the euro's got its own problems, sterling's got its own problems. None of these currencies are great. That's why I think people like gold. But if you really want to see gold take off, you've got to see a Fed that not only pauses, but starts to cut rates. And I think, personally, we're quite a long way away from that. And I think people don't understand the policy framework that the Fed's trying to pursue. When you have inflation of this sort of magnitude, particularly when you have low unemployment as well, which doesn't give you a lot of flexibility to grow above trend in a non-inflationary way, there's really sort of two policy options you have. There's what was referred to as deliberate disinflation. This is sort of the Paul Volcker, where you deliberately kill the patient. You drive the terminal level of rates to such a high level that the economy dies, dead, done. Inflation, everything's killed, right? But obviously at a huge cost to individuals and to the government deficits. The second option, while more benign, isn't without its problems. And this is called opportunistic disinflation. And this means that you trade off essentially that ultimate level of terminal rates, Paul, with how long you keep rates restrictive. And so I think the big problem that the market's got is it continuously looks for, the muscle memory we've built up since the global financial crisis. Rates go up, immediately cut, right? And I think we're in a very different framework. I think we're in a framework where, to use the vernacular, higher for longer. And we just sit here for a long, long time. It doesn't mean you couldn't get, a slight tweak in rates, as inflation drops a little bit and they don't want real rates to rise too much. But this idea that we've risen them now and now the next thing is cutting and risk is off to the races again, I think is utterly, utterly wrong. The intention from all my policy context is this is going to take a long, long time to grind things out. And when I mean long, I'm not talking necessarily months. I'm talking potentially years of restrictive rates with sub-trend growth. And that's bad for all assets.
Will the delicate interplay between gold and the Federal Reserve's policy decisions continue to shape the narrative? And how will investors navigate the evolving landscape amidst the potential scenarios of a substantial breakout in gold prices and a shifting economic paradigm? In times of crisis, how do investors safeguard and access their gold holdings effectively? Share your thoughts in the comments below. If you liked the video, please subscribe to our channel and remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.